Hi, everybody. This is the Beats Roundtable. I am Herb Greenberg, and today is Monday, August 5th, 2024. Today, we are exploring whether we are about to see a repeat of 2007 and what our pros are eyeing, buying, selling, and shorting. With all this chaos and volatility, we bring you exclusive strategies and perspectives you will not find anywhere else. Joining me now are 7 of the best and smartest investors I know. Robert Marson, Bob Morris, Jeff Mackey, Larry Peck, David Maritz, Stephen Lamar, Benjamin Bry, and Charlie Peabody. Okay, Charlie, on July 19th, you said, and I do quote you, there will be a very sharp double-digit decline in the market in August. And you pretty much called Friday's dip to the day. So you've also been saying there are things in this earnings season that are kind of giving you those 2007 vibes. So Charlie, not quite a double-digit yet. Where's your head? What are you thinking today?
Well, before I get started, let me just say, the reason you want to come to Wall Street Beats is you're going to hear things on this podcast that you're not going to hear from Wall Street because they're conflicted. I've spent 40 years on Wall Street, 20 years at many of the bulge bracket firms, and I know how the analysts there get muzzled. The people on this roundtable and in this podcast are going to tell you what they truly, truly think. So you really want to listen to the brilliance that is assembled here. The second thing is I always found that the buy side very often was way ahead of the sell side. And these are all people that are portfolio managers that know and anticipate things way ahead of the sell side. So I really think you got to listen when Catherine Spurlock tells you to short, Brunswick Corp, or Larry Peck tells you to short Carvana, or Ben Bry comes up with a brilliant interest rate structure, or Robert Marson tells you there's a plungette coming. I mean, and then on the long side, there have been, Nadine's telling you how to hide in the exchange traded companies, or Bob Morris is telling you to buy American Electric Power. So I think, these guys know how, and gals know how to make money, and you've got to listen to them. That said, I do think that what we're experiencing today is a warning shot. And I don't think this is the 2008 event yet. I am expecting a recession in 2025. And I think with recessions, it's not uncommon to see 30 to 50% drawdowns in the market. This one, as I said earlier, is going to be short in terms of time, and the time was August, sharp in terms of magnitude, and the magnitude is double digits. But I think it's a dislocation that the other people on this roundtable are going to be able to give you some great ideas as to how to take advantage of.
So with that said, what are you doing? I mean, you have these trades on. You have the banks have obviously been in the news. You had the Warren Buffett move on Bank of America. People are trying to interpret that, and his move on Apple. You're sitting here saying, you love a stock like Citi. Has any of this changed anything for you?
Not really. I mean, I'm in the market this morning with the bid on Citi. It hasn't been executed. I've been taking out my seed money on some of my trades. I own some of the September 5,400 puts on the S&P 500. Bought those around 50 last Thursday, and they're selling for 270, 280 today. So I'm taking seed money out, but I'm leaving, the house money in because I don't think that this correction is over with yet. Now, could we get a midweek rally, if we sell off hard today? Sure, but that's going to be tough to play. So I'm being patient here and, putting in some very out of the money bids on stocks.
Okay, so when you talk, though, about the 2007, you've been mentioning that sort of along the lines, and we see this kind of thing. And where does that fit in the scheme of things, Charlie?
Well, I really should turn it over to Ben. He is brilliant on this subject. So why don't I do that? Let Ben chime in here.
Yeah, so I've been writing a little bit of an essay about this, and everyone here remembers summer of 2007. Ironically, we peaked on July 12th, 2007, similar almost to the day this year, and then we get basically the Salwood fund gets sold to Citadel, 2 Bear Stearns hedge funds go out, and then they were credit funds, but then we get the quant blow up in August, and that's really when the financial system got pretty loose, right around this exact same time. So, that was about a 10 to 12% decline. Then we get a rally into the first Fed cut. And, it's crazy, but it feels like it's playing out very similar. You know, a lot of what's going on right now has more to do with positioning and leverage and a lot of carry trades unwinding. But I think everyone on here will tell you that it's not as though the economy's knocking the ball off the cover. It's not in a terrible position yet, but it's, you know, I think the writing seems to be on the wall for a lot of people.
When I was asked why was I expecting, you know, a correction in August, I gave two very high level themes. One is that the narrative had gotten way ahead of the fundamentals, and that certainly has played out in AI. But in the space that I know, financials, you know, the assumption was that credit was going to get better, and I was saying, you know, it was seasonal. The expectation that NII, or net interest income, was going to accelerate, and I was questioning the ramp up. The expectation was that capital markets were about to, you know, just shoot through the moon, and I was saying that the first quarter was probably your peak quarter in capital markets revenues. So the narrative did get ahead of the fundamentals. And the second thing is what Ben alluded to, and that is that, you know, I felt that the positioning gotten very one-sided. There was no risk management below 5,500 on the S&P, and I pointed that out as an important level when it broke. And, you know, so those things tend to snowball in a situation like this, where you're in a market that's a month of typically very light and illiquid. So it's very tough.
Charlie and Ben, is this move in the market enough to get the Fed to emergency cut? I mean, is just the market going down 10% from the highs enough to get them to start thinking about it?
Right. When you get into these kind of markets, things do break, and it's very difficult to anticipate how they play out. You know, so, you know, I think that the Fed will react as opposed to anticipate.
You know, one underlying factor, if you look over the last 50 years, 3 of the 6 recessions we've had have been preceded by a spike in oil prices. And what's interesting is that, you know, Ben, you talked about 2007, and then it was sort of mid-2008 that we had the spike in oil prices. That sort of, that combined with the subprime mortgage crisis, really kicked things in the gear of the recession we had then. The underlying factor you've got today is what's going on in the Middle East. You know, and the headlines this morning is that Biden has been called into the Situation Room. Harris has been pulled off the campaign trail to the Situation Room. And things are very volatile in the Middle East. And something is going to happen there. I mean, everybody's fully anticipating some recourse by Iran against Israel. And I mention that because that could light a fire in the oil prices. So on top of everything else that you're seeing, everything else that Charlie highlighted, if we now get that spike in oil prices because of some broader conflict in the Middle East, that's just throwing fuel on the fire, essentially, for a recession. And if that were to occur, you know, normally I would not, you know, buy energy stocks into a recession. But now you've got this situation where if we get, you know, the geopolitical concerns in any event there, you know, it could work against you as far as a recession. But at the same time, owning energy could be a little bit of a hedge if we see that spike in oil prices. But the big concern is that, you know, throwing fuel on the fire if we get a spike in oil prices for the economy.
If we could bring it back to sort of this 07 versus what we're seeing now, you know, 07, having been managing money at a hedge fund at the time, you know, that was more of that was a real problem in the plumbing of the financial system. I'm not seeing, and look, and I would defer to Charlie on this, but I mean, I'm not really seeing that. You know, when you bring it back to sort of it's never different this time. You know, we have roughly 2 recessions every decade. 2 in the 70s, there were 2 in the 80s, 2 in the 90s, 2 in the noughts. I mean, it's, you know, this is not unusual. And so I do think that there's going to be more to this sell-off than we're seeing now. I think people are just getting used to the idea that the Fed may be behind the curve. I don't think there's going to be an interim cut. And we may be going into a recession, and we have to start pricing accordingly. I wouldn't read too many signals into what people are rotating into and out of today. Right now, people are just going for cash. But I do think that there is, when this is all said and done, there will have to be a reallocation to things that are going to benefit from the lower interest rate environment. So I think that it's going to be a really difficult transitional period for some people, but this is not the end of the world. And and people are going to have to adjust their portfolios for the new reality of where the economy is, where interest rates are going, because people, the market was mispricing a lot of those they're going to have to get on sides very, very quickly here.
No, I was just going to agree with Larry. The U.S. banking system, at least the large banks, are in much better shape this cycle than they were ahead of the great financial crisis. And I think they're going to come out of this recession next year in much better shape. I think the problems are outside the banking system, in the shadow market banking system. It's in private credit, private equity. It's in these monoline, car companies or credit card companies, or, industries that are financing their product, like, Harley Davidson or Brunswick Corp or Polaris. So I'm not as concerned about the system. What I think typically does happen in a recession is that you see corporate margins will drop by about 30%. And that's what causes that 30 to 50% correction in a recession. So basically,
Marcy,
I would say it's
think?
going to be an earnings sell-off and not so much of an economic debacle.
I'm just watching and cheering the markets lower, because I sold a little early, raised a lot of cash, put some shorts on, and still don't have any new buys on my new buy screen. The market is still too expensive, and those that have economic sensitivity have massive negative revision. So you can't count on the earnings level to be good going forward, especially if we're going into a recession. So I'm just sitting tight, waiting, and opening files on companies, as I've been doing for months on this show, waiting for lower prices.
What about the stocks you've been buying? What about the ones that 2 weeks ago or a week ago you're sitting here thinking about because you thought they were great ideas? What do you do with those? Do you just sit on those? Do you own those? How does that work?
Let's quantify the situation. I have put 3.5% position on in 9 months. Everything else has been 1% starter or a lottery ticket or just opening a file. So I did buy, and that one position is CRNT, and I'm still a buyer of that until I see the news for the quarter. But everything else, including something like Expedia, which I thought I was early on, bought 1%. I'm watching it, and if it goes down another 10%, I'll probably buy another percent, average in, and then I'm going to see what the new numbers are after the quarter, because there's obviously going to be some negative estimate revisions going forward for sure. So I just think you take it slow. I'm in no rush to buy the starter positions I have, the 2 or 3 that I've made on this show. Some I've already sold, as I mentioned before. Some of the economically sensitive stocks I've posted in real time in our chat, like Seco was in and out in 4 weeks. Those things have already been there, done that, because the fundamentals have changed. I'm very, very willing to sell something at a small gain or small loss when the fundamentals change. And I think the trigger of the SOM rule sets us up for, as Charlie said, a recession next year, if we're not in it already. And because most of the time you've been in it when that rule has been passed, with the benefit of hindsight. So I think I bought the last 3, the recession is here dip in the last 2 years, and this one I'm not buying yet.
So Ben, when we get back to your scenario, and since you've been so good with the way you viewed what you saw coming based on interest rates, and you start talking about 2007, if we were to follow your scenario and what's going on in your head, and you were trying to strategize here, and just say you were not the trader you are, but you are someone who just sitting here has a portfolio, has a retirement account, starts seeing the news today, freaks out a little bit. If you're right when you start talking about 2007, how should those people be thinking?
I mean, look, if you want to know what I'm doing, I'm taking a lot of these positions off on Friday and today. As I like to talk about, the role of convexity is you own that insurance for days like now. And then when you get the move vertically, you are the one you're taking the position off, because it's basically guys getting blown out right now, right? So I'm with Charlie. I don't think that this is like going to cascade. But look, the thing in the Middle East is real. On the show last week, I recommended buying longer dated oil as also a hedge against the scare. If let's just say the ISM came out okay this morning. And one of the things that I would tell you that you could push back upon on the jobs report is there's a lot of guys talking about the impact of the hurricane in Texas, and how many jobs were off because of that. So we'll have a report August 16th from the BLS, and we'll see in the beginning of the month. So that there could be a head fake component to this. I wouldn't recommend doing anything in a 50 vol environment. It's a very difficult time to trade. If you weren't positioned, I don't think this is the day to be like repositioning.
The one trade that I would still position and press is the housing market trade that I've mentioned several times previously. I still think, and I'm not worried about the banking industry, the way it got hurt by housing in the great financial crisis, but I still think that there has to be a significant drop in home prices before we see a comeback in unit volume. And the bull thesis is that the demographics won't let that happen, and I disagree. So anything, and I'll leave home goods to these other people who know it better than I do, but anything that's housing related, whether it's roofing or insulation, or carpeting, the Mohawks, the Mascos, the Beacon Roofing, and the home builders. I've been talking about shorting Toll Brothers and Beazer and Kaufman Broad, KBH. I think that has a long, long way to go. And that's part of my recession thesis. Housing is such a big part of our economy. When that goes and people start spending on a deflating asset, it really hurts the economy.
Of course, somebody could sit here and say, but wait a second, Charlie. We understand, if rates fall, and we know that's a bad sign for the economy, it's reflecting the economy. And there's this dichotomy between falling rates in theory should loosen up the housing market. So how do you foot that one?
Well, I have two responses to that. One is, mortgages are 6 to 7% nowadays. You're going to have to get down to 4% to get a real boost to the mortgage financing part of the housing market. And I think that's going to be difficult because as the Fed is forced into a rate cutting mode, you're going to start to see this yield curve turn much steeper and positive. One of the trades I have on right now is IVOL, which is a play on a steepening yield curve. So I think it's going to be difficult for the long end to come down much more than where it is right now.
Okay, Ben, you have this company you like. It's sort of a lottery ticket, BETR. It's a mortgage company. So how does that fit into this environment? Does this change your view on it? Are you more ambitious on it? And what do you think about what Charlie just said?
Well, I think that mortgage rates are pretty high. The spread between the mortgage and the long end is extremely wide, and banks don't really want to lend because they're pretty much guaranteeing, or they think rates are coming down, and so they just know that if they write that paper that the prepayment will come. So look, volumes in mortgage volumes in the mortgage market plus the home refinancing have been nascent, and the government's trying to get behind it, and lower rates should improve volumes. So look, that is the lottery ticket. But if we get that environment, it should benefit from that.
Okay. Hey, Jeffrey, you're sitting here listening to all
yes,
this.
Sir.
You focus specifically on the consumer in so many ways. I suspect your portfolio is much broader than just consumer and retail. But when you hear all of this and you watch all of this, how are you positioned going into this? And from a specific stock picking perspective, is this a period where you start thinking about things to buy, or is it a period where you sit on your hands?
Herb, it's August. August is all about making a list for your holiday gift choices. What I'm looking for in the correction, and in terms of what Ben and Charlie, who've had the hottest hands here, what they're actually doing is they were right. They're not going out and buying protection today. They're not reducing the exposure. It's too late to be selling right now. What the sell off, it reminds me of 2007. I was there. I was on TV talking about it. It also reminds me of 97 and 98 when I had just started my hedge fund, and I was not on TV because I was getting my brains kicked in by long-term capital management and the freaking Thai bot. It's like, holy crap, the Thai bot. I'm not seasoned enough to know about the Thai bot just yet. I just have, please, Mr. Market, stop beating me. But people forget that's when the circuit breakers first were put into play, and they worked just as horribly as everyone kind of expected they would. You give people 20 minutes to think about how panicked they should be, and they will, in fact, figure out a reason to panic when you reopen. Anyway, so I'm saying that their trades are based on the now. And right now in the now, I'm looking for this this sell-off has officially become kind of a run-of-the-mill correction to a thing people are talking about in the street. So I'm looking for which means it's becoming emotional. And emotional dislocations are when you get the hottest price swings. How that's playing out in my book, I'm still long. We've been talking about it freely, just kind of raising cash. We're getting to the point now where, of course, I'm not nearly hedged enough at all, really, and just kind of long cash and comfortable with it like a blanket. Now is when you want to be deploying it, and I'm looking for dislocations as a sign of kind of the end of this whoosh down. I'm looking at Walmart. That's playing with its 50-day right now. It closes below there. It's got kind of a straight shot to 60. That's only about 10%, but that's a name that I can own in the recession. That's a name that I can own for a lot of different reasons. It'll make the price cheaper, and it gives me, frankly, something to do. When I see Schwab is down today, as our mini brokers, it was just reported.
I should point out, Schwab, the service, as opposed to the stock, stock might be down, but I'm just talking about the services now.
Oh, yeah, the service. Well, what they do for a living for their clients, for the millions and millions of people. It's, to be honest, I'm not a shareholder, and I'm not that concerned about their options. But I am concerned about the service, and what I'm really interested in is that many people trying to sign on. I would love to know what they were going to do in terms of transactions, if they were going to hit the sell button or be buying the dip. The action's still a little ambiguous in terms of what we can actually get through in trades right now. But, you're still seeing a little stick in names like Walmart. You're still seeing some bid, not much, but a bid on some of these names that have been largely ignored. I would expect those start to get weaker as the sell-off builds and we start to get to that whoosh moment. The next trade easier move is going to be a bounce. We've been down. This is the third straight day of kind of increasingly terrible days. The VIX has spiked like crazy. Two guys on the golf course asked me about Japan's crash last night, which is, these are anecdotal tells, but it's not nothing because no one wants to talk to me about things like that on a regular basis. When stocks are good, 3 months ago, they just wanted to tell me about their NVIDIA. So I think we're getting to the point where now people are afraid enough that you can look for a bounce back, reposition then, and that's going to be when you want to do transactions. Right now, again, I'm making lists of specific stocks, and I'm respecting the charts just for the previously stated emotional reasons. Amazon closed below its 200-day last week. That matters to me. Bad things happen below the 200-day. That's not a stock that you necessarily need to be a hero on. Huge admirer of the company, still owns some shares, sold some shares, repeating the point, not enough. should have sold more, but it's not something I'm particularly concerned about. My cost base is much lower, So it's a time to chill. It's a time to look for good things to break and to put in kind of bids under the market.
This is the kind of market where research is your friend. If you haven't done the work, you're not going to be prepared or willing to step into names that you love. And that's why things like, unfortunately, you have an account at Schwab. I was trying to buy some Aon when it was 80 this morning. Unfortunately, it's now back to 84. So I did not get hit on that. But that's the kind of thing where if you have confidence in the research that you've done, that is your friend, because then the volatility doesn't mean as much to you as it does to other people who may be panicking a little bit more.
Go on.
Oh, just to make this point on Walmart, because it's a specific trading point, that $60 level is also where the chart gaps from where they hit earnings in May. So we're talking about layering kind of a process over the tendency to be emotional, to get worked up about these things. Homework is your friend. From a fundamental basis, they work okay in a recessionary environment. From a technical trading basis, that's an area that you want to take a shot. You can put a stop underneath. You can protect it however you want, just in case it doesn't hold. But that's the next line of support. And just knowing that is a better thing to be looking at today than trying to log in and sell whatever's making you nervous.
Okay, so you're saying that Walmart you'd buy at 60. Larry, you're saying Aon you would buy at 80. So you answer my question there. I think that's what I'm hearing you saying.
I mean, if I get a shot again today, I will be there with a buy order for sure.
Okay, hey, David, so from your perspective, where you focus on healthcare and you also have other things you own in your portfolio unrelated to healthcare, but you're very stock-specific type of a guy. So in this environment, what do you think? What are you doing? Are there things you're actually thinking of buying, or are you just sitting on your hands?
Yeah, so mostly sitting on my hands. I mean, so two or three things came up during the earlier discussion. So first, are we in a recession? Are we not? I mean, I think we all know enough or have seen enough and know enough people that are struggling. And so whether we say it's technically a recession now, whether we're going toward it, we know that they're not as good today as they were maybe a year ago. And it seems to be a trend. And we had low price gas for a little while. Now it's inching back up. We have political things. So the way I look at it is, yeah, the outlook's not great. But when you have something that's $100 and it becomes, $95 or $90, does that all of a sudden make it cheap? Now, maybe there are some things on everyone else's radar that goes from expensive to cheap. I don't think so, and at least not in healthcare. The things that are really expensive, like Lilly, are expensive now, and they were expensive 2 weeks ago. So in things like this, if you press your shorts, that's not a bad idea. At least in my experience, it's not a bad idea because things tend to get worse. I try to focus on things that I want to own for 5 years. So, things that are super cheap like Teva or Haleon or Viatris, they're a little bit less sensitive to this. Now they're down with the market, but I think in a bigger correction, they'll do better. As for protecting yourself, we have a different group of people who listen to Wall Street Beats. Some are super sophisticated, institutional investors, and others are individuals. And in my experience, chasing after protection on a day-to-day basis is really dangerous. Like trying to buy levered ETFs, inverse ETFs and things like that. I've made a lot of money doing that, and I've lost a lot of money doing it. Net, I've made some money doing it, but that's a trade, and that's if you're a trader, great. I'd rather own something like I think that Robert was saying it, of looking out a few years of things that I want to own. Are they getting to be super cheap? And nothing that's on my radar right now is super cheap, other than the companies that I mentioned.
Think about from perspective of what's changed, and to Larry's point of the transition period could be rough. If we think about the last 4 years, like what's worked, stocks, oil, gold, and what's not worked, bonds, the yen, Chinese stocks, and they're all symmetric around the RMB, US dollar. And so now we're starting to see the yen work and bonds work. And the one thing that we haven't seen in that is the Chinese stocks. And as the yen devalues, it's actually better for the Chinese exporters. So I would urge, and I have been saying this since we started the show, is start maybe looking at China a little bit. It's very out of favor, and they've gone through some issues, but they've done a decent amount of deflating already, and they're not like way overvalued like the U.S. market is.
I have a question. Can crude oil, the product, work and the stocks not work?
It can if the whole market's down. I mean, crude oil could hold flat, and it's down a little bit today, but you look at names like Chevron, Exxon, they're all down 3%. So they're going to get caught in the downdraft of the overall market, even if oil's just holding in here like it is today. So, yes, but if crude goes up, if it spikes 10, 20%, the stocks are going to go up. The stocks are going to outperform. You're always going to be fighting the headwind of a down market if the market's collapsing. But if oil goes up a material amount, I think the stocks will work. Now, oil can outperform the stocks as it goes up because the market tends, or investors tend to discount any run up in the oil price and not give full credit to that in the stocks. But yes, oil could work and the stocks not do as well. But, as far as the oil names, again, it's tricky. I'm what am I doing? I'm nervously holding on to my names. I mean, I've got the names that I like, C&Q, EOG, Chevron, Exxon. The one that I'm looking at that looks intriguing down here, Chevron. It's underperformed the last few days, partly on maybe a little bit disappointing earnings on Friday and people being concerned about this Hess acquisition being delayed perhaps up to a year. But if there's one energy name I'm watching closely that I would add to, it'd probably be Chevron down here as I watch how far things pull back.
Okay, and before we get to Steve, who has a final question, I do have one thing for you, Bob. You say nervously hanging on to your names, and you have names like C&Q, which are your number one holdings, which you really like. So when you say nervously holding on to a name like that, when you see things happening here, what does that really mean?
The nervousness is that nothing happens in the Middle East geopolitically and we go into recession. So if there's no geopolitical event to take supply off the market and we're going into recession, demand's going to come back in a recession. And so the only thing that holds energy up in a recession is a geopolitical event. But you've got a high likelihood of that right now with what's going on in the Middle East. And, is that short-lived and we go back to normal? I mean, the last time, Iran tried to respond to Israel killing a leader was sort of symbolic and nothing really happened. This time, is it going to be that situation again, or is this really going to develop into something that's a deeper, broader conflict? I don't know. So that's why I'm saying nervously holding on. C&Q, I still love. The thing is, I wrote a little bit of call options on part of my position a few months ago, and the strike price is below the market today. So actually this morning I rolled some of those options with the stock when it was down sharply on the open this morning. I rolled some of those call options forward. That's what I did. But, the stock's above the strike on those call options. So that's sort of how I'm, what I'm doing there. But I love C&Q and I'd be holding on to it here.
Okay. Final question goes to you.
So I'm curious to hear this from the group. There's a lot of anticipation, I think, coming from this Fed cut. And when it does actually happen, does that event trigger you to do something one way or another? Are we all just kind of waiting for the Fed to finally cut and then we start doing something, or does it have no effect? Let's see how things trade if and when they do it, and then go from there.
I'll start off. I think you have to see what level we're at when the Fed does cut. I wouldn't rule out, a midweek rally here, whether it starts, whether it's Tuesday, Wednesday, Thursday, or Wednesday, Thursday, Friday. I think some sort of bounce typically occurs in these violent type of corrections. But I don't think this correction is over with. I think that bounce is hold into.
My question, Charlie, is are you in a mindset to buy the dips or sell the rips from here?
If we get this midweek rally, I'm going to sell that again, because I don't think this correction is over with.
Do you think it could get closer to a 2-handle than a 1-handle?
Yeah, I'm loath to put a price on it. I'll stick with it's going to be double digit, whether it's 10%, 15%, or 20%. I don't know. These are the kind of markets that become very unpredictable. I had written down 4 things back in July that I was going to look for to tell me we're close to the end. And one was that liquidity becomes terrible. And that means you start to see a widening bid-ask spread, along with, possible trading halts like we saw in Japan with circuit breakers. And the wider bid-ask spreads means greater volatility, and that exacerbates P&L statements. So that's hard to know how that plays out. The second thing is that you're going to see a lot of forced trading. And Jeff Mackey alluded to the emotional response that you're going to get. But you're also going to get hedging. You're going to get forced degrossing. You're going to get margin calls. So that's the second thing I was looking for. The third thing is that, you're going to find that brokers and exchanges, and I literally wrote this down earlier, are going to turn off access. So you're seeing, Fidelity, Robinhood, all turned off access. Brokers don't pick up their phones in markets like this. And then the final thing is you still have significant negative gamma right now in this market. And I'll, defer to Ben to explain that. But until that gets corrected, I don't see a sustained rally here. So those are the 4 things I'd written down.
Thank you.
Okay, David, last comment goes to you.
First of all, so healthcare trails the S&P by only 150 basis points year to date. That's an 800 basis point or 8 percentage point increase in just the last month. I think it's anticipating a rate cut because riskier investments, but also on the defensive side, you have pharma and some managed care and things like that also doing well. So look, I think that I'm not waiting for a cut. I think though that healthcare and buying more healthcare in the last month or two has really been with the idea that things have been trailing too much for too long. And I think it will catch up in a defensive mode if we do end up into a recession. So that's why I'm kind of comfortable holding some of the biotech names and some of the healthcare names.
Okay, everybody. Thanks a lot, David. And thanks to the group. That is it for today. Thanks for joining us on the Beats Roundtable. I am Herb Greenberg, and we will see you tomorrow.